And in its latest bid to speed up the resolution of the bad loan problem, the central bank has further tightened its rules to push more defaulters towards bankruptcy courts. The new norms will also help in abolishing half a dozen existing loan restructuring mechanisms. According to the RBI, the new ecosystem will force lenders to file for insolvency proceedings against defaulters with 2,000 crores or more if a resolution is not implemented within 180 days of the initial default.
Restructuring mechanisms and coming with one mechanism which encompasses of the whole gamut of things with more clear guidelines and more clear deadlines.
Mr. Mohapatra, in a way this also means that it will be like a round-the-clock monitoring of bad loan situation and early recognition of any problematic account. Though it appears to be pretty dynamic in compared to the previous accounts, how effective would it be in your view?
Actually, it is a very good natural consequence, natural development in view of recent changes in government regarding IBC policies and then our experiences in handling the SDR, S4A, all those things, and going forward, it is in sync with all the best practices in developed economies, so that everybody will be serious about addressing the issue, and then promoters will show more skin in the business. So it's a very good move, perfectly in sync with best practices of developed economies.
Mr. Bajaj, though almost all the strategists and experts we are speaking to are lauding RBI this move, but at the same time, in the near term, analysts are saying it could provide a bit of a pressure because of perhaps requirement of PSU banks to take big provisioning upfront and hence eating away into a lot of possible profitability going forward. We have already seen some of these PSU banks provide for almost 4 or 5 quarters historically, and now this will actually again give a bit of a mountain to provide for. Do you think that is a bit of a issue?
See, basically these new rules have come up from the RBI to quicken the process of identifying NPA positions, because whatever earlier this SD4 and S4A and CDR mechanism, that in most of the cases we are not seeing any resolution, and it is basically postponement of the recognizing of overall NPA position of the banks. So with this, definitely yes, it will quicken the process of NPA identification and resolution of the same.
Let's get on board Neha Bothra, who joins in with more details. Neha, run us through RBI's new norms. Clearly it's going to help tackle the bad loan menace.
The Reserve Bank of India issued a circular on Monday that clearly promises to usher in a new era as far as reporting, recognizing and resolving stressed assets in the system is concerned. In fact, the Reserve Bank of India has clearly instructed banks to refer outstanding loans worth over 2,000 crore rupees for insolvency proceedings under IBC norms. Not just that, for any outstanding dues where the resolution plan has not been implemented within 6 months, the Reserve Bank of India wants these loans to be referred for insolvency proceedings. More importantly, do remember that tools used earlier by banks like SDR, CDR, S4A, even the JLF mechanism stand abolished, and the insolvency route is the route available to banks to resolve stressed assets. How fruitful this will be for banks is something time will tell, because do remember there's a lot of instability as far as the implementation of insolvency proceedings is concerned, but the Reserve Bank of India wants the process to be more transparent and effective. In fact, all resolution plans require to be vet by at least 2 credit rating agencies if the loan is worth over 500 crore rupees, and these credit rating agencies have to be authorized by the Reserve Bank of India to do so. All in all, the Reserve Bank of India abolishing earlier restructuring tools like CDR, SDR, S4A, even the JLF mechanism to make way for transparent resolution process under IBC norms by way of insolvency proceedings.